Welcome back to Pro Tips with VRG, where we welcome professionals from all different industries to give you advice. And today we have none other than Miss Susan Allen from Susan Allen CPA, a local certified public accountant.
And she is going to answer some frequently asked questions that homeowners and investors ask about tax benefits. So Susan, thanks for being here with us today. And we want to first start with the obvious question. What are the tax benefits of owning a home?
Well, thank you for having me here today. There are quite a few benefits of owning a home. The most obvious, what most folks know of, is the mortgage interest deduction. And the mortgage interest deduction is deductible if you itemize deductions on your tax return. Well, however, a few years ago, the standard deduction was increased quite a bit. It actually doubled, and which made the mortgage interest not really deductible for a lot of folks that didn't have a large mortgage interest deduction. Nowadays, with the higher interest rates, I foresee that we're going to see that mortgage interest deduction coming back as itemizing deductions, especially if folks have charitable contributions on their tax return.
That's good news.
That's it. It's important to have the charitable deductions with your mortgage interest as a strategy so that you can itemize deductions instead of using the standard deduction, because the standard deduction actually hurts you on the state return, because the standard deduction in the state of Maryland is so low, you end up paying more taxes if you don't itemize deductions.
Giving always wins, part of the tax strategy, charity.
So the biggest advantage to owning a home is that it's an investment. It's an investment just like your stock portfolio or your retirement account. It's going to grow over time. And so truly the biggest advantage is when you go to sell that home, that there is no tax due on that home, as long as your
capital gains tax, right?
As long as your capital
right.
The capital gains on the sale of that home is less than $500,000 if you're married filing jointly, or $250,000 if you're single.
So for some of the people out there, what is the definition of capital gains?
Okay, good question, because I get that question frequently. So capital gains, to hit that 500 or that 250, a lot of folks think, oh, I sold the house for $700,000, I'm going to owe capital gains. No, you're not. So if you sell that house for $700,000, but you bought it back in 2002 for only $400,000, the gain is only $300,000, 7 minus 4. And so then no capital gains would be due if you're married filing jointly, because it's under that $500,000. Now there's some other things that go into that picture that we can add to that cost, like your settlement cost. If you made any improvements, you remodeled the kitchen, you finished the basement, you added an addition, all of those things can be added to that $300,000 original cost basis.
That's great information for homeowners. Now, the other piece that we want to talk about is investors. I know we've had the conversation about our personal investment portfolio, but for everybody out there that might have some investments, tell us a little bit of the tax advantages of real estate investing. For example, land, rental properties, second home, things like that.
Okay, so we'll start with land. So, which are great questions, because I get these all the time as well. So purchasing land, there's no tax deduction for purchasing the land, even if you have a mortgage on that land. I should say the mortgage interest goes into an investment deduction. So if you have investment income, then that interest could be deductible. But there's a lot of times it doesn't end up being a straight deduction. So it is important to make sure you hire a CPA so that these things are reported correctly. The next one is vacation home or second home. The mortgage interest is deductible on your home, and this works. And I love vacation homes or second homes as a deduction. One, you get the personal benefit of it, but the other reason is the mortgage interest is deducted, and it also is another investment for your portfolio. That the growth on that, when you go to sell it in the future, you get those funds in your pocket, but you do have to pay capital gains, just like your stock portfolio.
Sounds like we need a vacation home.
Now, how about more of a traditional rental, say a single family or condo?
Okay, rental real estate is a great investment. I have them personally myself, and it's a great addition to your portfolio, whether it's your stock, retirement, again, because there's a different reporting. You'll collect rent, you'll report the rental income, but you get to write off all of your expenses that you put into the property. Now, it's possible if your income's too high, you won't get to write off those if it's showing a loss on the property. But some typical examples of expenses that you're able to write off are anything related to that property. Your HOA dues, if you paid the electric bill, the Comcast bill,
repairs, upgrades, things like that.
maintenance, anything related to that property is deductible. But however, if the income minus those expenses with depreciation equals a loss, if your income is greater than $150,000, you're not going to see that benefit on your tax return. And I get a lot of clients that are upset about that. However, I just tell them that loss, I'm just going to keep continually carrying it forward, or I'm going to carry forward those losses until the sale of the property. And then they'll get to recoup those losses that they didn't get the benefit of in the prior years.
Excellent.
But the same thing here. The growth on it is going to be taxed at capital gains rates, which is better than ordinary gains. So having a rental real estate, a vacation home, are all taxed at capital gains rates instead of your ordinary rates. Your ordinary rates are whatever tax bracket you're in, depending on what income. And it could be all the way down, the lowest is 10%, but all the way up to 37%.
Wow.
And capital gains is fixed at 15%. Some, depending on what your tax return looks like, there actually is a 0% capital gain. And I love when this happens with clients that all their other income is below a certain threshold, and they sell that piece of property and they pay no capital gains on it because they fell into that 0% capital gain rate.
It's a nice little surprise at the end.
That's a good day.
There's also if your income's high enough, like it's over like $400,000, there is a 20% capital gain rate.
And Susan, we have a few experienced investors that use 1031 exchanges. Can you just explain that a little bit for everybody?
Sure. 1031 exchange is a fantastic strategy. I love when clients do a 1031 exchange because they are deferring the capital gains on the sale of the property with the replacement property. And I'll explain a little bit how this works. So you must hire a qualified intermediary to handle this entire transaction for you. So you sell the property you want to replace. It's called a like-kind exchange. And you have 45 days to identify the new property. And then you have 180 days from the sale of the original property to go to settlement. So you have very strict guidelines on how a 1031 exchange works. And it's very, very important that the money at the sale of the original property does not touch your hands. It has to go to an escrow agent, which is the qualified intermediary, to hold those funds until you go to settlement on the replacement property. And if you follow all the rules, you pay no capital gains on the sale of that property. So this is a great strategy if you have a very large gain on a sale of a property you don't want anymore.
So you mentioned like-kind exchange. Clarify what that means in this process.
So like-kind exchange, there are many definitions of like-kind exchange. A lot of people, from many years ago, they've used the word Starker exchange or 1031 exchange. They all mean the same thing. But it's basically, the IRS has changed the rules that a like-kind exchange means what it says. It's like-kind, it's real estate for real estate. That's the only things that qualify for.
Regardless of the type of real estate.
It basically, yeah. But double check with your qualified intermediary to get all the fine details of what you're allowed to do as you're going through the process of identifying that next property.
Thanks for joining us today, Susan. It's always a pleasure talking with you. We learn something new every time we chat with you.
And thank you for having me here today.
Yeah, thanks so much. And if you're navigating taxes in real estate, be sure to hire a CPA and a real estate professional. And if you like these pro tips, please subscribe, like, and follow us on all our social media platforms. So until next time, my friends, live light, live big, and hire a CPA.